The global spotlight has turned to the East Africa community with the discovery of vast natural resources, making the region a rich hunting ground for companies such as Irish exploration company Tullow Oil, British-based BG Group, and China National Offshore Oil Corporation. With capital inflows on the rise towards prospecting and exploration of minerals, gas, as well as oil in Kenya, Uganda and Tanzania, the trading bloc, ranked as one of the fastest growing regional economies in Africa, stands out among its peers.
To create that attraction in East Africa, we need to create a climate where there is certainty, where there is transparency, where people can plan on a long-term basis. If we are able to create that climate, yes, we can grow very fast. And the advantage of East Africa is each of the countries are small, it's very easy to commute, we have already reasonable transport infrastructure, we have got good human resource, which is essential compared to other parts of Africa. So we have a huge advantage over the rest of Africa.
I think the notion that the region is individual or singular in nature, I think is that of the past. We have to look at the region as one. The resources, some of them actually lie across the borders. If you look at some of the figures and the maps that have been shown in the presentations today, you'll see some of the oil, in northern Kenya borders southern Sudan, for example, and to the west slightly it borders with Uganda. So the resources are not homogeneous to a particular country, but to the region.
Banks eager to diversify their revenue streams are targeting investors who are seeking billions of dollars of capital to fund their ventures. From project financing to equity, to consortiums, various financial tools are now available for investors who are eyeing the sector, which is at its infancy.
What is becoming popular is the partnership between government and the investor. And I think this is very important in the context of what is happening in Kenya. It's also happening it's currently happening in Tanzania, in Uganda, and also in West Africa and Southern Africa, where government are providing the platforms, providing, for example, the exploration permits and opening up the ground for exploration, and the financing, the investors coming in and saying, okay, we will pay for the rest of that. And that money is being raised through global financial markets, essentially through speculation. People say, we think that there's going to be a huge find here. Will you put your money in this? And we're offering X percent on the return of investment. So a lot of it is through debt.
With a $4 million investment, Stockport, a Canadian firm exploring for gold in Kenya's western region since 2011, says investors need to be prudent with cost at the initial stage of exploration.
Most of our financings are done through equity raises, so we issue new shares. We also look at debenture activities, and we have a number of innovative instruments that we can use. But over the life of exploration, from basically early prospecting to the point you've delineated a proven resource that is large scale, it's not unusual for companies like ours to spend $60 to $100 million in that process.
Investors and experts participating in the mining conference in Kenya were, however, cautious of the unpredictable operating environment in East Africa, posing a high risk to the cost of doing business in the region.
If you look at taxation of resources, there are three parts that come in. It's what you get from royalties, what you get from taxation, which includes direct and indirect taxation. And if you look at the current royalty rates, they are quite significantly different between the three countries. Tanzania is very favorable in its royalties. Kenya has gone to the other extreme end, where its highest royalty on diamonds is 12%. So there's a big difference there. On VAT, Kenya gives a total exemption on VAT on any supplies. Tanzania, on the other hand, or Uganda, don't give exemption on services. You look at the income tax rate. Uganda on minerals it's different. They've got a variable tax rate depending on the gross margin, while Kenya and Tanzania have a fixed rate. So they're very different even within minerals. Carry forward of losses. Kenya and Tanzania restrict carry forward of losses. Uganda, there is no limit on the carry forward of losses.
There's an absolute correlation. The higher the taxation and the royalty, the lower the level of interest. Now, it's the country's natural resource. So they have the absolute right to determine where do they want to be on that spectrum. If you want to be high, you'll attract a little less people, but only really high quality projects can go forward.
Data from the United Nations Economic Commission for Africa shows the EAC community will expand to 6% this year, up from 5% last year, boosted by, among other things, the natural resource discoveries. As the investors race to have a piece of the natural resource discoveries in East Africa, the three countries need to capitalize on economies of scale in order to net in more foreign direct investments.
We looked at cumulatively what the East African community has attracted over the past 10 years, and it is half of what Nigeria attracted in the same period. So clearly, it tells you that there is a potential there for the community, partner states, but also the community as the Secretariat, to come together, harmonize their investment strategy, their investment policy, and harness in all those resources that are coming in. What we're observing at the moment in the region in terms of foreign direct investment is it's not exclusive to the extractive sector. You know, in Kenya, a lot of FDI up to today, or let's say 2013, for example, has focused on financial services, telecommunications, ICT. In Uganda, you've got a bit of extractives. In Tanzania, a lot of extractives. So there's something that is happening, and I think certainly Kenya is going to join that club of extractive nations, and the potential there to attract a lot of FDI is very high.
You know, it's easier for people to do, you know, two developments or, you know, explore two mines in two different countries because you can move the equipment from one country to the other. So it makes the cost of doing business better. It gives somebody a bigger coverage. Rather than covering a population of 40 million, you're now covering an area of 250 million. Okay? So even the attractiveness of, you know, moving around will become easier, and that is why East Africa needs to look at, we are very small in terms of the current global potential. So we have to bring ourselves together. It's a simple thing. You know, if you take a fist, it's more stronger than one finger. And if you look at the 5 countries of East Africa, it's a fist. That's what you can get by bringing these countries together.